Good morning, everyone, and welcome to the 2020 virtual High Desert Real Estate Symposium. This is our fourth series, and today we will be covering the state of commercial real estate and also a residential housing update today. I'd like to go ahead and introduce our panelists today. Thank you very much for attending. Chris Lammer with Coldwell Banker Home Source will be presenting on residential. Executive Vice President Bob Basin with Coldwell Banker Commercial will be presenting today on industrial. Jared Schindel, Vice President, Coldwell Banker Commercial, will be presenting on multifamily. And Terry Sines with Coldwell Banker Commercial will be presenting office. And I will be presenting on land, capital markets, and retail today. So with that, let's go ahead and get started. I'm going to go ahead and share my screen. Okay, we'll start today with 2019 in review. A lot of this information was compiled in February. We did go through the information and update it just recently. As many of you know, we were going to be holding our symposium in early March, and we had to suspend it, obviously, because of COVID-19. So first, we'll start with 2019 before we get into 2020 and our forecast. So this is activity for 2019. As you can see, industrial was the dominant sector in our area, primarily because of a few large sales, including Dr. Pepper, which I'll talk about in a little bit, and also retail. Retail also had some large transactions within our region in 2019, followed by land and office, a little under $30 million in transactions for office for 2019. In this slide, you'll see that we've broken down the activity by city. Victorville had the most activity, primarily related to industrial, as you can see, followed by Apple Valley. And you notice the green portion of Apple Valley is retail. It really represents one large sale, which was in the Just Ranch Marketplace, which sold for $89 million. So it kind of skews the numbers a little bit. And then, of course, followed by the other municipalities, Adelanto, Barstow, Hesperia, and the rural area, the unincorporated parts of San Bernardino County. So this is a review back to 2001 of activity. I've used this slide in the past. It's updated, obviously, for 2019. Again, I want to point out the land activity in 2003, 4, 5, 6, and even 7, which is the turquoise color on this graph. Tremendous activity during those years. And then, of course, the subsequent Great Recession, activity fell off in all sectors, especially in land. As you move to the right, you'll notice that the activity did resume. We did have a recovery, and our numbers in general, while they have not quite gotten to 2005, they are still reminiscent of 2004 and 5, excuse me, 6 and 7. What's different, though, is land. You notice that land really makes up a small percentage of the overall volume. Our volume has mostly been dominated by industrial and retail. And really, I'll talk about in a little bit in the land portion. We've moved from a heavy speculation market to what I call a normalized real estate market. This puts it in percentage. Again, you can see land was a dominant force in the mid-2000s. As you move to the right to 2019, you can see we have more of a balanced real estate on the commercial side as far as industrial, retail. And land is a smaller portion of what it once was. So this is an overview of the activity for 2019. Commercial sales, which include industrial, retail, and office, represented $445 million. It was actually up 70.6% over the prior year. This was really pushed up by a couple large sales, including Dr. Pepper and Just Ranch Marketplace. 701 transactions, so our total transaction volume was up almost 10%, and we ended the year with approximately 189 available properties on the market, which represented a 17.1% increase in total available properties. Land had almost $100 million in sales volume for 2019, up 20.4% over the prior year. Transactions were down slightly, 6.6 at 1,041 transactions. Less transactions, but higher volume, which means a higher sales price per acre on land. Total available properties year-end was 2,702, which is a very slight decline over the prior year, 1.6%. So overall sales volume of 543 million, an increase of 58% over the prior year, and 1,742 transactions, 11.5% over prior year. Again, this represents higher selling prices for both land and commercial properties overall, but significant increase in overall transactional volume. So with that, we're going to move into our first segment with multifamily. I'd like to introduce Jared Schindel with Coldwell Banker Commercial. He's going to go ahead and give an overview of multifamily for 2019 along with the forecast. Jared, welcome.
Thank you, Jason. Thank you, everyone. Excited to be here, excited to speak on this. As you know, topic near and dear to my heart. So we'll go ahead and jump right into this with our first screen here. Jason, if you want to go to that first slide for me.
There you go.
All right, thank you. So this is just really everything. As you can see, town of Apple Valley, Hesperia, Victorville, on fire, price per unit, price per square foot, everything went up, everything hunky-dory, demand's in shape, everybody's excited, and really those numbers would be even higher if inventory was not a factor. The theme that you're going to hear today, not enough inventory for demand. There's more buyers than there's available properties. As you know, creates huge increases in price and things sell quicker and much faster overall. So you're looking at two cities that you may go, hey, what happened? What happened to those two cities? And we're talking specifically about Barstow and Adelanto. So Barstow, you see from 2019 to 2018, the decline of almost $10 million. That, however, was just one property. There was one large property that sold in 2018 for $10 million. Other than that, you're pretty much all the same even keel. And the data doesn't tell the real story. The real story is that there's not enough inventory there. If more people put their properties on the market, sales volume would double, maybe even triple. There's huge demand in Barstow as well as Adelanto. And we're going to touch on Adelanto a little bit more specifically towards the end, specific property that had multiple offers. But every property in Adelanto that's reasonably priced is getting multiple offers. So that sales volume number, again, is not because people are scared of Adelanto or Barstow. There's just nothing available. So as we kind of proceed, people ask me, what's selling? What do the units look like? How do they feel? What's going on? And no surprise if you're in the market or if you've looked for an apartment recently, they're mostly 2 bedrooms. 59% of the units up here are 2 bedroom, and that's going to play very important in the next data as you see kind of where we're at on rent and rent per square foot. The surprising part is the 15% with 3 bedrooms. That's actually just a few properties. So there's a few properties that comprise most of the 3-bedroom inventory in the whole valley. So not a whole lot of 3 bedrooms out there. It's on the apartment side if that's what you're looking for. Very few, very limited. Moving on to cap rates. So this is obviously the most important valuation tool that we use to kind of determine value. And this is the only slide that you're going to see a forecast on. And the reason I thought it was kind of important just to differentiate it between COVID and non-COVID. So as you can see, since 2010, cap rates have just declined, which is good. Properties have been more valuable, rents have gone up, more demand. And we've hovered around 5.5 to about 6.5% on a cap rate. Just regionally, that's where you're going to be within those lines. There's some that are a little higher, some that are a little lower, but generally you're going to be 5.5 to 6.5 with about a 6.25 on average cap rate when you factor in all the data. Now, looking ahead, what are we going to see? So we're going to see a little slight tick up, 6.5%, but it's going to level back out. And the only reason is the lenders. Lenders are pulling back a little bit on the amount of money. They're still lending money at great rates. We just got a quote yesterday, 3.5% on a 10-year for a 10-unit apartment building out in Apple Valley. So the lenders are still there. They're just pulling back on the LTVs. So we used to be able to get 75%, possibly 80 if it cash flowed properly, and really do really well. So you can get in 20-25% down, have a good goal of that. Now they're a little bit more hesitant, 30-35% down, but that'll level off towards the end of the year. Once rent collections go back to normal, everybody's back to work, the economy levels out, we'll kind of see it go from there. And you can kind of see that in the graph as we move on towards the year, which leads me to the next slide, occupancy rates. Your apartments aren't worth anything if there's nobody there to rent them. So where are we at? How does that look? We've been pretty healthy in the 94-95% range. Now I do want to point something out. 16, 17, and 18, That's a little bit of an anomaly. So there was a lot of properties that traded hands in 16, 17, 18, where they went in and raised rents significantly on tenants. That's raising rents. Those tenants obviously couldn't afford it, moved out. You had downtime, rehab, and then you had tenants that obviously need to be placed. So you had about, on average, 60 days of dead time on these units as they were being refurbished and brought back to the market. That 1% in those years actually pretty much accounts for that. So there hasn't been any drop in occupancy. It's still been pretty stable at 95%. And actually, as we trailed off in 2019, it was getting closer to 97%. So we're still waiting to see what the effects of that is on COVID. Currently, we did not that long ago, we did a survey, and they're still pretty healthy, around 97%. So we're keeping an eye on that, and definitely plays into what the value is of the properties. So that's great. They're full, 97%, 95% occupancy. What are we getting for rent? 95 cents a square foot on average. And the top end of the market, we're seeing $1.35 a square foot. Bottom end, we're seeing about 70 cents a square foot. But on average, about 95 cents a square foot. And a lot of that has to do with, going back to that previous slide, 59% of our units are 2 bedrooms. So there's a lot of data in that one point. So it skews it a little bit, but on average, that's where we're at. And that equals to about $900 per unit for a unit out here that should be rented. Now that'll view obviously by size, amenities, things like that, but we just look at the data, 900 a unit, which leads me to some notable transactions. So this is my favorite part. We get to talk about the actual real estate, not the data. As much as we love data, I prefer the real estate. So this is a 120 unit apartment complex in Victorville that sold for just a little bit over $14 million. This building was actually sold a few years previously. The owner came in, added some money, fixed it up, turned around occupancy numbers, increased rents, which again leads to that little dip in occupancy rates, and turned around and sold it for a pretty good profit. And the new owner that's getting it, substantial long-term investment, it'll do really well for him as well. This one in Hesperia, 24 unit complex, sold for 3.9. This is a turnkey deal. Somebody bought it, they're going to hold on to it. They love it. It's a good project, beautiful property. The 48 unit complex in Adelanto. So going back to Barstow, Adelanto, what's going on in those two cities? And nothing, just no inventory. So this 48 unit came on the market, and it had multiple offers within a week. They were up to 4 or 5 offers. They actually took a lower offer price-wise than what was available to them. It was a 1031 buyer, reduced contingencies, quick close. That was more important to this particular seller than anything else. So they actually took a little bit less money. They could have gotten 3.6 million. They decided to take this one, quick close. They had other things to do with the money. And last but not least, we have Apple Valley. I could have put 20 different properties in here for Apple Valley. There really was a smorgasbord of properties that kind of changed hands. This one sold for just under 2.1, mostly 2 bedrooms, right there in that Quantico area, right off of Apple Valley Road, south of 18. Really, really decent area. It's growing. A lot of those properties have changed hands, new ownership. That area you can kind of see is gentrifying. And I actually lied, there's one more. Last but not least, for sure this time, 36 units in Barstow, sold for 1.7. I picked that picture because it has B Hill in the background. There was better pictures, but I went with that. It had 8 vacancies at the close of escrow. It had tons of capital improvements that needed to be made, and just really was a value add all the way around. The guy that bought it, he was a newer investor to the area. He just purchased units up in Apple Valley and Victorville the year before, was doing well with them, decided to take on the challenge. At this point right now, he is at full occupancy, has already refied the property, and is doing quite well. It's cash flowing really, really well. So that kind of leads a summary. Where are we at? What happened? And the moral of the story, huge demand, low inventory. It's going to keep going. COVID will cause a little bit of a hiccup, but we'll be back swinging, in no time. With that, I'll turn it back over to Jason.
Jared, thank you very much. Next, we're going to go through office, both 2019 and a forecast. I'd like to introduce Terry Sines. Terry Sines is with Coldwell Banker Commercial, and there you go. Terry, good to see you. I just gave you control. You're ready to go. Tell us
I'm
what
ready.
office,
Thank you, Jason. I'm so excited to be here And well, I was going to say to see all your lovely faces, but I can't see you. Hopefully next year we'll meet in person so I can see all my friends again. So with that, let's go into the market snapshot of the office sector. So the vacancy rate declined in 2019, ending at 5.8%. And that equated to about 270,000 square feet. The asking rate edged up to $1.49 a square feet. And then the high desert as a whole experienced positive absorption of 86,900 square feet. So the office market sector, you can see this graph, it breaks it down by the city. It encompasses 5.6 million square feet. Now that's about 881 buildings. Now, most of that stock is B and C type buildings, and that's largely occupied by the private sector. So almost all of the Class A premier buildings were actually constructed and delivered between 2004 and 2011, and those were mainly constructed by your government and public agencies. We had no new deliveries in 2019, but we did have 86,000 square feet under construction. Now, the increase in demand of office space due to the health services industry that we've seen in the past, that has declined because local hospitals are now able to provide office space for their medical personnel in their own facilities. So that made that one go down a little bit. So now this is the number. So you can see the vacancy rates and the asking rates per city. So the sub-6 vacancy rate of 4.8%, that actually favors landlords. Now, there were a few buildings that have a high vacancy rate, but for the most part, most buildings have a pretty low vacancy rate. Now, the asking rate per square foot edged up over 2019, 1.4% to $1.49 a square foot, but the rents are still below replacement costs. Now, one of the reasons for that is that landlords are lowering rents to keep existing tenants, but at the same time, they're trying to gain new tenants from similar buildings. So you have that little price war a little bit going on. So in general, the available office space is really in older buildings, and so that makes them a little bit geographically and functionally obsolete. The buildings that we need that are in high demand, they're in limited corridors. So think about the medical sector. All of those medical buildings are actually centered around the 3 hospitals. And there also appears to be a shift of demand of office space into retail centers instead of in freestanding office buildings, which I've really found interesting and have experienced this year. So next we have a graph of the rental and vacancy rates. Now, if you look at 2009 to 2019, you can see that the office market has really been relatively stable, but the effective rents are still below the level required to support the development of speculative office space with little to none of it pre-lease. Now, excess vacant space in some neighborhood and power centers is also expected to temper the rise in office space. Now, much of the leasing activity for office involves your typical population of tenants such as finance, insurance, real estate, and the professional services like attorneys and CPAs. When the population grows, this segment of office space demand is expected to expand, but it's going to be at a more subdued rate because the trend has been, even pre-COVID, to reduce the amount of office space needed per employee and transitioning to a more mobile office or remote or working remotely. And we'll talk about that in a little bit. So let's talk sales. Last year, there were 20 sales that amounted to $27.6 million. Now, the average sales price was about $1.4 million. The median sized building was 5,000 square feet, and the median sales price was about $770,000. So, and the price per square foot ranged between about $60 a square foot up to almost $141 a square foot. I mean, $311 a square foot, with that median range being $141 a square foot. The cap rate ranged from 6.12% up to 7.5%, with that median range being at 6.75%. So let's look at our first notable transaction, and that's what you have on the screen. This was the second largest sale. This was the Spirit River Complex in Apple Valley. It is a 30,390 square foot multi-tenant building. Now it sold for $220.47 a square foot for a sales price of $6.7 million. The largest sale happened in October, and this was in Adelanto. It is a 20,800 square foot single tenant building. It sold for $240.38 a square foot for a total price of $5 million. So, pop quiz. Let's see how much you remember. So, let's review. The vacancy rate decreased in 2019, 6.8%, ending at 4.8% vacancy. Our lease rates edged up 1.4%, ending 2019 at $1.49 a square foot. Positive absorption of 87,000 square feet, no new inventory. The lease rates remain below the level required for new construction. Many of the buildings are geographically and functionally obsolete. And most of the new construction is limited to owner-user. So our forecast pre-COVID-19 was that the lease rates were anticipated to remain stable with a slight decrease in vacancy rates. So where does that leave us now in this COVID era? So we finished strong in the office sector. Remember, increases in absorption, lease rates, decrease in vacancies. How is this going to play out in the long run? We're not really sure. It's going to take some months to kind of get a feel for where this is going, but we do have some assumptions we can make. Transitioning the workforce to work remotely, as I said earlier, was already a trend in 2019. That's probably going to be accelerated because businesses are able to use platforms such as Zoom and Office Teams to conduct business with their employees. And some businesses are not bringing their employees back this year. The tech giants, Google and Facebook, have decided to let their employees work from home. So during this shutdown, employers have learned they can still function, they can still do business efficiently, but they need a smaller footprint now. So let's actually look at some statistics. In 2010, the average square foot required per employee was 240 square feet. In 2019, that dropped to 130 square foot per employee. Now this was pre-COVID. So in one decade, the amount needed per employee dropped 46%. I mean, that's huge. That's almost 50%. Moving forward, if this continues to hold and the transition is to keep workers working at home, we could see a further reduction of 10 to 20%. Now, there's been minimal office construction in the Valley as a whole. Most of that has been specific to owner-user. So with the further consolidation, we don't see office increasing. We actually see a decrease of rates and an increase of vacancy, which is flipped from the pre-COVID. So only time will tell. Maybe in the third quarter, we'll get a better idea. But until then, fingers crossed that we'll be able to recover from this. And with that, back to our fearless leader, Jason Lamoureux. Boom.
Terry, thank you very much. That was very informative. We're going to move into the industrial sector next. I want to introduce Executive Vice President Bob Basin with Coldwell Banker Commercial, who is going to cover the industrial market. Bob, how are you doing today?
Doing great, Jason. Thanks a lot. I'm real excited to be able to do this today, and I'm really happy that everybody's taking time out of their day to participate in our virtual symposium. Although all things being equal, I'm looking forward to next year when I can see everybody that I'm talking to. Anyway, real quick, industrial market did well in 2019, just continuing a trend that really started in about 2013. Kind of a snapshot of our whole industry. Vacancies throughout the high desert, 5.5%. Lease rates up to $1.29 a square foot. And we had positive absorption of 1.7 million square feet. Okay, so let's look at our inventory by a municipality. Victorville obviously has the lion's share of the industrial at just over 8.6 million square feet. You'll find the majority of that is at SCLA and over at Foxborough Industrial Park. Adelanto, Apple Valley, and Hesperia, all right around 4 million square feet. Barstow just under 1.2 million square feet. and the rural areas of the county have just under 200,000 square feet. Our numbers, vacancy rates, Adelanto, you can see, has the highest at 14.1%. And that's basically because the cannabis cultivation business has kind of cooled down, and we'll touch on that a little later. But if you look at the vacancy rates for the other cities in the town of Apple Valley, Apple Valley's under 1%, Barstow's under 2%, Hesperia's under 2%, Victorville's a respectable 5.2%. All of these vacancy rates are very low as compared to where we were in 2008, which is another graph we'll take a look at. Your asking rates, Adelanto, again, because of the cannabis, has a much higher asking rate per square foot at $1.74. But keeping that in mind, in 2016, we saw rates as high as $4 a square foot. The balance of the other municipalities in the high desert, you can see, are all very close, within almost 10 cents of each other. And those rates have also increased because of what we call traditional tenants that were kind of forced out of Adelanto when the cannabis went in there, and they had to find space in the other cities in the town that really had a fixed amount of space. So it decreased vacancies and increased asking rates. Our property mix, you can see by the pie chart here that the majority of our industrial space is over 50,000 square foot. We have a huge demand for 10,000 to 50,000 square foot. And so obviously you can see by this chart that we're short there, and we desperately need to build some of that. Our rental rates and vacancy rates. This is a 20-year timeline you can look at. What really interests me here is if you look at 2008, we hit a vacancy rate, that's the green line, of 14%. But since then, we've predominantly, the vacancy rate has been declining. And conversely, you can see that we had kind of flat asking rates between 2011 and 2014. But really from there on out, the rates started going up. And then of course in 2016, when we had the great marijuana rush in Adelanto, rates kind of skyrocketed. Now, that's not just Adelanto. Again, there was a lot of what we call traditional tenants that were kind of forced out of Adelanto that had to go to, Barstow, Apple Valley, Hesperia, and Victorville. And again, we had very little limited space there as it was. So that increased and put pressure and increased all the asking rates in those areas as well. Notable transactions, Jason had mentioned the Dr. Pepper Snapple facility. That was part of a 5 or 7 property portfolio sale. That total portfolio sold for $353 million. In the Foxborough industrial area, there was another property there, 450,000 square foot, was part of a 55 property transaction, a portfolio sale that was traded at $1.2 billion. So we had a couple of properties in the high desert here that were part of portfolio sales, and pretty big ones. So reviewing our market, vacancy rates have decreased 2019 over 2018 at just over 15%. Lease rates continue to go up and ended the year around $1.29 a square foot. We did have new deliveries in 2019, just about 1.5 million square feet. We had 1.7 million square feet of positive absorption. And notably, the Big Lots facility, which is up and running now, which was a new delivery at 1.35 million square feet, that was obviously the lion's share of the total 1.5 million square feet that was built in 2019. Touching on cannabis again, that demand has cooled. I'm not sure that the demand for cannabis is cooled, but the real estate part of the market is cooled. And the reason being, in 2016, when, like I said, when the great marijuana rush happened, that whole market was driven by speculators. That is cooled. The market now is driven by the users, the cultivators. And, they've pretty much, well, one thing they found that's taken much longer to get their licenses so they can get their doors open. and they just could not, their business model just did not work at the rates that were being charged in 2016. Again, excited about new construction with the higher lease rates that fortunately the tenants have been able to absorb. With those kind of lease rates, that should facilitate new construction, which we need desperately because of the demand. So 800-pound gorilla, where are we going for the balance of 2019 because of the COVID-19 pandemic? I looked at three things. One, demand. Demand is still high. That has not backed off at all. Two, we haven't seen the new construction, particularly in that 10 to 50,000 square feet range. So we have high demand and we have very little availability. And what's really pleasing is that lenders are still lending on industrial. Unlike some of the other buildings that we have in our market, they feel comfortable with the industrial market, and the lenders that we are working with have not changed any of their underwriting guidelines at all. So we have great loans at great rates that are available. So with that being said, I don't really see any downside in the industrial market as a result of the COVID pandemic. Although only time will tell. We'll certainly take a closer look at that at the end of Q3, beginning of Q4. But that being said, that's my story and I'm sticking to it. And thank you very much again for taking your time out to participate today. And Jason, I'll turn it back over to you.
Bob, thank you very much. With that, we'll go ahead and move into retail. Retail actually in 2019 did very well. The retail vacancy rates dropped slightly to 8.4%, ending 2019. Lease rates moved up 1 penny year over year from $1.10 to $1.11 average, and 53,000 square feet of positive absorption. So we were green lighted across the board on all key indicators in retail. Again, this is a by city slide. As you can see, a predominant amount of retail is located in Victorville with almost 7.5 million square feet, with Hesperia, Apple Valley, and Barstow falling with approximately 3 to 3.2 million square feet of retail. The rural area is 745,000, and Atalanto's at 305,000 square feet of retail, primarily located on Highway 395. There have been some new projects proposed for that region, and we're looking forward to hopefully they come to fruition. Let's talk about vacancy rates in the ask per square foot. Atalanto, obviously with less than 400,000 square feet of retail, they're pretty much sold out. 2.6% vacancy rate is significantly low in the retail sector. It really represents just turnover from one tenant to the next when there is vacancy created. Very tight market. Apple Valley at 9.8%. Now, at the end of 2019, the former Lowe's building had not been leased. At 139,000 square feet, it represents a large portion of the vacancy factor in Apple Valley. That was leased in early 2020 to an RV storage company, and we will see the vacancy rate in Apple Valley decline or reduce significantly in 2020. Barstow at 7% is fairly respectful, and Hesperia at 6.1%. 6% is really kind of the threshold where it becomes a tight market, anything under 6%. And as you can see, Victorville, rural areas, and the high desert on average is at 8.5%. Victorville slightly above that, and the rural area is slightly below that. So ask rates. As you look to the right, you can see it's fairly common between the municipalities and the county, ranging from 99 cents a square foot up to $1.29 per square foot. This is base rents, excluding triple nets and CAM charges. Again, fairly stable year over year. So taking a look, a 15-year review, as you can see from about 2013, which is really when we started the recovery from the Great Recession, just small improvements year over year. Nothing, just at the runaway pricing, but you do see vacancy slowly coming down from its peak in 2012. down to 2018, 2019. So we have been slowly leasing up the retail, primarily related to neighborhood retail. Most of the expansion that we've seen in retail of new construction has been related to power centers or regional shopping centers, High Desert Gateway, also out on Highway 395 and Highway 18, Palmdale Road. But most of the vacancy remains in the neighborhood small product sector. So I'll get to that in a second. As I mentioned earlier, Just Ranch Marketplace sold for $89 million, representing almost 400,000 square feet. Cap rate was 8.2%. It's actually a fairly high cap rate for that asset. It did trade along with High Desert Plaza, which sold for $15.8 million at a 7.5 cap rate, representing approximately 104,000 square feet. And another interesting sale, it's really I'm going to talk about capital markets, was a single tenant Starbucks, which sold for $2.6 million, representing a 4.3% cap rate in 2019. $1,400 a square foot, very strong sale. There's, again, more capital than properties available, which is a common thread among all the sectors. So just kind of a review, vacancy rates did decline to 8.4%. Lease rates increased 1% year over year. We had 28,000 square feet, almost 29,000 square feet of new deliveries. So we not only absorbed the new deliveries, but we had a positive net absorption in 2019 of 53,000 square feet. The vacancy rate around regional centers, High Desert Gateway, Just Ranch Marketplace, Dunia Plaza, still remain 2% or less, which is an extremely tight market for the power centers. Neighborhood centers, which I mentioned earlier, these are centers ranging between 2,000 to 10,000 square feet. The vacancy rate did fall to 14.3, but it does represent the largest portion of our vacancy factor in the valley. New construction, again, focused around power centers, and growth for 2020 was projected to increase year over year. The effects of COVID-19 on retail, still unknown. We anticipate the vacancy rate on retail to increase. And as with anything, as the vacancy rate increases, we expect to be pressure on pricing, and we expect some pricing decline. Not much on retail, but it's still a little bit early. If you're watching the news, we are reopening slowly. San Bernardino County, I think, is reopening quicker than the rest of the state. So over the next couple months, we'll see how retail fares with people going back to work and reopening. So with that, I'll transition into land. In our segment a couple weeks ago, we talked about the Brightline train, which is going to be the Virgin train from Apple Valley, the Victor Valley, to Las Vegas. So we're excited about that. And before I get into that, let's talk about historical sales and transaction volume. This is almost a 20-year review of transactions for land, as you can see, and I mentioned earlier. The mid-2000s, the market was dominated by land sales, which really fell off dramatically in 2008. Probably the low point, as you can see, was 2012. And we've made a steady gain year after year. However, it's still a fraction of the land volume that was moving in 2005 and 6. Interestingly, transaction count has increased over since the Great Recession, 2011 and forward, just a nice gradual increase. I attribute this to a mature market. We really don't have speculation, and I'd say unwarranted speculation in this market like we've had in previous cycles, not just the 2000s, but also the 90s and the 80s. So we're hoping this is more of a mature market with shovel-ready projects, our end users actually purchasing land to go vertical. So the average transaction last year was $96,000 for vacant parcels. The smallest transaction was approximately $1,250, with the largest sale being a little over $7 million. Total sales volume was approximately $100 million. The average time on market was 198 days, with a total of 1,041 transactions for 2019. So just a quick summary of the 2019 activity. Transaction volume decreased 6.6%. However, sales volume increased 20%. Obviously selling vacant parcels for more than the prior year. New housing starts increased 8.9% valley-wide, and scattered single-family residential lots increased 18% year-over-year in pricing. Bob had mentioned earlier about the cannabis cultivation activity in Adelanto. Again, we saw a lot of speculation in 2016, 2017, and started to slow down in 2018. 2019 really was a transition to end users. Speculators were gone. We saw a significant decrease in asking prices for land, going from up to $1 million an acre down to $150,000 an acre. So a significant decrease in pricing on vacant land. Demand for retail land has been centered primarily in the power centers, Dunia Plaza, High Desert Gateway, Just Ranch. Infill land in the neighborhood area hasn't had as much activity, and land activity remains primarily focused on residential and industrial land, even through the shutdown of our state and through the COVID pandemic. So, notable transactions last year, 96 finished lots in Apple Valley sold for $7.2 million. They are going vertical on new homes as we speak. And an interesting non-cannabis sale in Adelanto, it's 40 acres sold to Coparts for $6 million, approximately $150,000 per acre. For non-cannabis, that was one of the higher sales in the valley for industrial land. With that, I'm going to transition into capital markets. Capital markets was a little slower in 2019, not because of demand, just because of available properties. We saw the cap rates increase year over year, and it's not reflective of demand. It was really a couple of the properties, including Just Ranch Marketplace and High Desert Plaza, which traded at a higher cap rate, which skewed the market a little bit. As I mentioned earlier, Starbucks sold for 4.35%, which was typical for a corporate tenant. Notable transactions included a retail center in Hesperia, a little under 20,000 square feet, which sold for $4.5 million, representing a 7.5% cap rate. This property was on the market for almost a year and a half. Primarily, price is what really led it to take a while to sell. Finally got moved down to a very attractive 7.5 cap rate, and it sold quickly. Another notable transaction on Main Street in Hesperia, 7,000 square foot retail center, including Aldi's and T-Mobile, as you can see, sold for $3.6 million. 6.6% cap rate, good investment, but interesting, it represents $517 a foot. So very strong transaction for 2019. And another transaction, 6,580 square foot building on Apple Valley Road near Bear Valley in the Home Depot Center, 6.5 cap rate, representing $532 a square foot. That actually sold to a user who opened up an incredible restaurant, highly recommend. Los Pollos Brothers, definitely give a shout out to them. Incredible facility. Red Robin, again, another asset that was on the market for a couple years. It recently sold, end of 2019 for $3.5 million, representing a 5.4% cap rate. Again, that was priced aggressively in the 4.5 cap rate for a while. Once the cap rate moved up above 5.25, the property moved fairly quickly. So those are notable transactions in capital markets. Capital continues to exceed available properties. Even during the shutdown of the state and the pandemic, it did not slow the capital markets or the investment grade properties. Still high demand. Buyers are searching in secondary and tertiary markets. Finding properties in the metro markets is very difficult. Cap rates are even down into 3%. So we've seen a lot of demand in the Victor Valley, people looking for 5 to 6% cap rates. And as you've seen, we've had some large properties trading even above that. Credit tenant properties have traded as low as 4.35%, which was a Starbucks last year. Several properties traded in the high 4s and low 2%. Interest rates remain low and really have fueled acquisitions. We're still seeing interest rates very aggressive, even during the pandemic. and banks are, we constantly contact local banks to see what their lending practices are during the pandemic. There has been some concern that there will be a tightening of credit. For some asset classes, there has been, but for owner use, investment, strong tenant, there's banks still lending and the rates are aggressive. Still a seller's market for net leased investment properties. So it's, there's a lot of buyers out there, still a seller's market. So year in review, we had conservative growth in all sectors. Housing starts are still below demand. Something that's also, I think, been good for our market is a lack of speculation. Vacancy rates among all asset classes remain low. Before going into the pandemic, the economy was strong. It was firing in all cylinders, low unemployment, historically low interest rates. We have 2 to 2.5 months of housing inventory. Again, very short inventory in housing. It was a strong market. We believe it's going to continue to be a strong market as we open back up for business as a state and as a community. And also, as Bob had mentioned, the cannabis industry did have a correction from not just the removal of speculators, but also the time it's taken a lot of the operators to get open and going. So we see the cannabis market in Adelanto will probably have additional corrections in the coming year, and prices probably flattening by the end of 2020. So current trends, as I talked, still strong demand for net lease investments and add value properties. Also, we've had companies looking in the Victor Valley for last mile distribution expansion into the high desert, the Amazon delivery type companies. In the housing sector, we still have a very low affordability housing index compared to metro markets like Los Angeles, Orange County, San Diego, Ventura. That fuels our housing market. As Bob had mentioned earlier, still have strong demand for small to medium format industrial buildings. Multifamily, the rates have increased to a level that is now, new construction is now feasible for multifamily. So we expect to see the multifamily expand in 2020 towards the end. Office and retail sectors are pretty much at a standstill as I speak. We're waiting to see the effects of COVID-19, whether the office market will shrink even further. As Terry had mentioned earlier, the significant decrease, approximately 46% decrease in office space per worker from 2010 to 2019, moving from an average of 240 square feet per worker to 140 square feet. We anticipate that number to even reduce further as companies use telecommuting and Zoom, like we're using today, to have their workforce return to work. So external influences, obviously Corona makes it to the top of the list. There's been a lot of talk. We've had economists on, not only for the symposium, but over the last 6 weeks talking about, is it a V recovery, L recovery, W recovery? One of the things that most economists do agree on, it looks like it's going to be a V recovery. That's what we see in the real estate market. Recession, as we know, recession is recorded by 2 negative quarters. Well, that's 6 months. I think most economists would agree that we are probably in a recession. We will probably be in a recession for the next 3 to 6 months. But interestingly, it's not real estate related. 3 out of 5 recessions are not real estate related. Obviously, we have concerns because of the Great Recession, which was very difficult, very deep, and took a long time to get out of. But if you look at the indicators, we are still short in inventory. As you saw, the vacancy rates are low across all sectors. We are low on industrial inventory, multifamily properties. Housing remains short. Chris Lamoureux will talk about that here shortly. So we see a V recovery and real estate really continuing to grow through the end of 2020, with maybe the exception of office and retail. Other external influences, California. Love the state, but sometimes the politics are a little bit difficult with regard to fees, regulation. Interesting, one item that has kind of gone away, but I do believe it will return, is the discussion about split roll tax, being able to separate commercial properties from residential and increased property taxes. This is a concern that we're watching very closely. Legislatures would like to remove residential and still keep it at the 1% plus local fees, and possibly take commercial to a 1.5 to 2.5, maybe 3% property tax level. That will affect ultimately tenants and consumers, which no one's really kind of thought through the process. It's about raising revenue, but ultimately rents will have to increase to absorb the increased property tax. Property tax is the largest single expense that a commercial property owner will incur each year. So if it goes from 1% to 3%, you can understand quickly what will happen to rents. As rents go up, businesses will have to raise their product or services costs, which will then ultimately be passed on to the consumer. So something to watch. We'll keep you posted on that. If it does come out, we strongly urge you to contact your local assembly person, our congressperson, our senator, and voice concern. Inflation concerns. We've had a lot of clients ask us what we think of inflation concerns moving forward. The stimulus program is absolutely huge. It's ultimately could be $6 trillion. We don't see an issue with inflation today, but obviously it may be a concern 2021, 2022. So we're going to keep a very close eye on inflation. Forecast for 2020, pre-COVID, as Terry had mentioned, 2020 was going to be a good year. We were firing on all cylinders economically. We look to increased rental rates across the board in all sectors, decrease in vacancy rates, just a stable year. And of course, then a little pandemic happened, which really kind of threw a monkey wrench in everything. So as I mentioned before, we still believe that industrial will have growth, multifamily will have growth. We do believe there might be an adjustment in the office market and possibly the retail market. So we'll be watching that very closely, and we will be doing quarterly updates for the symposium. So we will inform everyone of our next one, which will probably be in a couple months, just an update of where we are as a real estate community. Industrial lease rates, we should increase this year just because demand exceeds available properties. And land acquisitions will remain limited to end users. Again, practically no speculation in this market with related to land or new construction. So with that, I'm going to go ahead and introduce Chris Lamoureux from Coldwell Banker Home Source, who's going to give us an update on the housing market. Chris, how are you doing today?
I'm doing great. I'm glad to be here. Excited to talk about the residential housing market. I'm going to share my screen here. All right, we are a go on the screen. So let's quickly take a look at how 2019 ended. In general, home pricing was strong. The borrowing rate was the lowest since 1969. Inventory extremely tight. We had positive economic indicators, and consumer confidence was high, right? So a lot of that is still in effect now. Let's take a closer look at that. So let's start with California numbers. In 2019, 397,000 homes sold in California, which was a slight drop of 1.2% over prior year. And the California Association of Realtors attributes that largely due to the shortage of housing inventory. California also had its first double-digit increase in price in more than 5.5 years. The median price increased 10% from December of 2018, the largest since May of 2014. And for the year of 2019, the median price was $592,000, up 4% over the prior year. December sales specifically was up 7.4% from prior year. So let's take a look at some more recent numbers as how April 2020 closed out. The statewide median home price was $606,000, so obviously up from that $592,000, and as we closed the year out, down only 1% from March, and yet still up 0.6% over April of prior year. The statewide sales were down a little bit in April over last year, and seasonally adjusted down 25% from March over from last year. But that is attributed, as Jason mentioned, we have a housing shortage, we have a shortage of inventory, so if there are no homes to sell, our sales will dip. But our pricing is strong, And another positive indication is that mortgage applications have increased in April. That's just last month they increased. So we're seeing that on the front line too. We have a strong buyer demand. And I've kind of highlighted here, you can see regionally, the Inland Empire and San Bernardino counties. You can see that, for example, Inland Empire last April, 378,000 was the median. This April showed 390,000. In San Bernardino County, 305,000 last year, 325 this year. So pricing is increasing at a slight rate, which we feel is a stable market, of course. Let's take a look at days on market. They did fall significantly for California, statewide and regionally. And inventory, like I said in the last slide, is down considerably because we have a decrease in listings. And the inventory, you can see California reported 3.4 months in April, which is up from 2.7 months in March. Pretty much this April and last April were the same. If you take a look at specifically Inland Empire, you can see that last April, we had 4.1 months of inventory in Inland Empire, and now only 3.9 in the month of April of this year. San Bernardino, pretty much the same, 4.1, 3.9. So our inventory has shrunk from year over year. And now let's get back to our more local region, the high desert. Last year we saw multiple offers. Days on market were pretty much the same as 2018. Our months of inventory, of course, did decrease, as you'll see in the slides, and we had a slight increase in pricing. And as Jason had mentioned earlier, new home construction starts did increase in 2019. So I like this slide to show kind of where our, we may say our sweet spot, our highest turnover rate in sales price. And that in the high desert continues to be between 200,000 and 350,000. The bulk of our sales are done there. And if you look, I mean, hardly any sales above 500,000. So yes, we do move homes above that mark, but it does take longer because there are fewer turnover in that price point. And I know we've all gone over a lot of numbers. I just want to remind everybody that this will be the entire presentation on cbcsymposium.com. So, and this is going to show you kind of what happened, of course, in the last recession. We had, you know, plethora of inventory and not as many sales, right? So you can see with the yellow line that we've had seasonal fluctuations, and our number of sales, of course, are down in 2019 due to the shortage of homes for sale, but still strong buyer demand. It's a supply and demand issue. So there you can see the prior recession. You can kind of see the seasonality that we've been experiencing the last few years, more of a stable market. And days on market, this graph can kind of show you, of course, we had in the recession, homes sat on the market quite a while, but we ended 2019 at 57 days on the market. And I believe one of my slides will soon show that we're at 59 days on the market last month. This graph can indicate where our average price per square foot is and sales price. And of course, here in the peak of the season, we were up at the highest at 323,000 median price and $189 a square foot. And now we're more at 280,000. So we haven't fully recovered as far as pricing on the last peak of the market cycle, whereas a lot of regions in California already have surpassed last peak median price. So we have room for growth still. And this is an overview of each of our regions in the high desert, as well as the high desert in general here up on the top line. So you can see our median price in April was 279,000. We only had 698 homes on the market. Generally last year we had 1,000 homes. In December we had about 1,000, but we probably peaked at 1,200 homes on the market. So the inventory is super tight, especially during these the pandemic. We've had even more of a shortage of inventory to sell. So only 268 homes sold last month. And we averaged $155 price per square foot. So as you can see on the left over here, we've got 59 days on the market for the high desert, 2.6 months of inventory currently. And I put a note up here. I mean, we had 27 months of inventory in 2007. I mean, we were sitting on way too many homes. complete opposite now. So a bit of a review. Of course, the trend in pending sales at the end of last year suggested a very strong start for 2020 with moderate price growth. The COVID pandemic did pause that trend briefly, but the recent activity we have seen indicates a strong return to the market. And we're still 13% lower than the peak in 2006, and our year-over-year appreciation and pricing is steady and stable. Still, the fundamentals of the market are strong. The low interest rates, lowest in 50 years, and anticipate by the economists out there say that they anticipate that the Federal Reserve will keep mortgage rates near those low rates for the rest of 2020. So again, with the active listings dropping more than 20% of year end and even dropping more recently, we have a shortage of homes for sale. Of course, there are always political uncertainties, especially in this presidential election. Those could impact the housing market. Time will tell. I'll let the economists give us a forecast on that. But what's interesting is that Americans went into these COVID pandemic months with a very strong buying power. Record levels of equity, the percent of mortgage burden in households at a 10-year low, the cleanest credit markets with high credit scores, and not a lot of price growth. So we were extremely healthy going into this. And as we've seen is just a minor pause, and then buyers, confidence and back in the market is very strong demand. So I agree with what Jason was saying earlier. It feels like a V that we're bouncing back already. And essentially it's a balanced market because we have low inventory that favors sellers and low interest rates and below peak pricing that's a buyer's advantage right now. So we do a housing report monthly. So if you are super analytical and want to see all of this, we can get that over to you. Just reach out to us. Again, it was a pleasure to be here, and I'll hand it back over to you, Jason.
You'd mentioned recovery, and we're getting back to business. I think you had mentioned in the last 2 weeks, Coldwell Banker Home Source has put 75 homes approximately pending.
Yes, absolutely.
So people are still purchasing.
Absolutely, yes.
That's
There
great.
are some that are hesitant out there, but right behind them, we have another buyer that's ready to go. So we're getting multiple offers on lots of homes. We need homes.
Great. So again, thank you for attending our 2020 symposium. I do want to thank our sponsors, Armstrong Fairway Insurance, SCLA Logistics Airport, Desert Community Bank, Midway Home Solutions, Alaska USA Federal Credit Union, the town of Apple Valley and the city of Barstow, the city of Hesperia, CoStar, Robert Lovingood, First District Supervisor, thank you very much, Desert Valley Hospital and Desert Valley Medical Group, Enterprise Funding, Mojave Printing Solutions, Mortgage Solutions Financial, and Sterling Development. Thank you very much. This is made possible by their participation. Also, I want to thank our staff for making this possible, and also the presenters today. It's incredible information, and real quick, if you have any questions, don't hesitate to give us a call. I know we covered a lot of data today and information. But if you have any questions, give us a call at 760-684-8000. This is being recorded. It will be on cbcsymposium.com along with our prior sessions. And we're here to assist you in any way. Thank you for attending today, and we look forward to seeing you in the future. Thank you very much.